Hi, good morning. It's Mary Ellen McGonigal, and today you are with us on the MEM Edge Show. And this is the show where we point you toward strength in the markets, where there's movement, and it's always with an eye toward pointing you toward stocks poised to outperform the markets. And my goal with this show is to each week pull back the curtain, if you will, and share various ways that you can uncover not only the strength, but again, get in front of these stocks, these groups that are poised to outperform the broader markets. So let's go ahead and get started. Today, we are going to be taking a review of the broader markets. This is something I always like to start with because, of course, you do want to make sure that there is health in that broader market. You want to have a feel, a sense for where it is relative to historical standards and also to guide you toward your investment decisions. So we'll take a quick peek at the broader markets. We're also, of course, going to search for where the current strength is in the markets. We've had a little bit of a tough week. Certainly last week, the pause button was held for sure. So we'll go ahead and review what we're seeing here currently in the broader markets. And then also I was going to review how you can identify turnaround candidates. And I know I touched on that last week. The reason for that is because a lot of the strong stocks have gotten hit. So we are seeing some turnaround candidates starting to pick up in momentum. So we'll take a quick peek at that. And then also having a plan to curb your losses. And again, this is something I mentioned often as well, because with these faster moving stocks, they will go up faster than the broader markets, but unfortunately, they also decline faster than the broader markets. So you do want to make sure you have a plan in place so that if your particular stock does in fact start to decline, you want to make sure that you have an exit plan in place. So we'll review stock that to give you an example of some of the characteristics to look for if your stock is starting to deteriorate so that you can, again, exit in a timely fashion. So let's go ahead and get started. This is a daily view of the S&P 500 large cap index. And what I did want to point out to you, this is as of last Friday's close. I realize that we are down a bit today, but last Friday we did have quite a bit in the way of negative action. The S&P 500 was down actually over 2% by midweek, close to 2%. And of course, all of that was focused on the worries with the China-US trade war possibilities. And so what we did see is the index break below this key 50-day simple moving average, and that is this red line here. And from my work when looking at the broader markets, a break below the 50-day simple moving average is in fact a red flag. It is not encouraging or something that we want to see. But the good news as of the close last Friday was that the index had a bit of a rally at the end of last week. So it did close the week above this 50-day simple moving average. The other thing you want to pay attention to is the slope of this 50-day simple moving average. And we are still in an uptrend. Certainly it does appear to be flattening, but we are very much more in an uptrend as compared to this period. Of course, the beginning of the year, we had a correction, and we certainly are still recovering from that correction. And what I did want to point out to you is what we are looking for as the next possible area of support in the event if this index were to break the 50-day moving average. We are looking at this actually more recent low here in June as this next area of potential support. The other thing I did want to point out is when looking at the daily price chart for the S&P 500, I do like to put the stochastics on at the bottom. And this is a technical overlay that is a little more forward looking than the RSI or the MACD, it's quite helpful in identifying potential turns. And what I wanted to point out is historically, going back to February and the end of March, beginning of April, when the stochastics get down below this 20 level, it indicates that it's oversold. So there is an anticipation and an expectation at some point we will get a bounce. So we are currently in that oversold position with an eye toward a potential reversal or bounce. So I would urge you to keep an eye on that as a guidepost. So here we are taking a look at the Nasdaq composite, again, a daily price chart. And the Nasdaq has been leading the market. And prior to last week's break, the index the prior week actually had hit a new high midweek, and the index was up over 9% prior to this break. Now, last week, of course, with the trade war possibilities, technology stocks were hit quite a bit harder, of course, due to Trump's comments regarding the Chinese and banning potentially their participation and investment in U.S. technology companies. And tech stocks, of course, took it on the chin. But the beauty here, again, is that the Nasdaq did find support. And notice this 50-day simple moving average is very much more in an uptrend. So the Nasdaq, certainly as of the close on Friday, continues to remain in an uptrend. And we do have a similar phenomenon with the stochastics. In this case, they are more poised to turn up. So we will review some of the larger stocks in the NASDAQ that are looking quite appealing right now. But let's go ahead and take a look. I talk about being on the prowl for where the current strength is in the broader markets. Now, last month, June, we did, in fact, see a fairly significant rotation in the broader markets. Prior to June, it was clearly technology stocks, and in particular, software and semiconductor stocks that were leading the broader markets. Then, as we emerged into June, we did see quite a significant pickup in consumer cyclicals. For those of you that have been watching this show, about 4 weeks ago, I did in fact, point out the significant move into this cyclical sectors fund. And then as the month progressed, we began to see a move into consumer staples. So what we are looking at here is from StockCharts.com. It is the S&P sectors view, and it's taking a look at the performance over the last month. This is as of last Friday's close. So in fact, we can see quite clearly that consumers are in charge, if you will, and both consumer groupings are quite advanced as far as their moves over the month of June. And utilities have picked up quite a bit as well. Now, of course, we know that consumer staples and consumer utility sectors are defensive in nature, and given the increased volatility surrounding potential trade wars, we are in fact seeing a move into these defensive areas. But there is another reason that the staple and utility areas are picking up, and that has everything to do with the fact that interest rates are declining. The 10-year is down in the 3.75 range, and 2.75. And so we are seeing a move into these higher yielding groups as well. So let's go ahead and from there take a look at a daily price chart of the consumer staples industry grouping. And what I did want to point out here, using again these simple moving averages, this 10 is your 10-day simple moving average. The 50 is red, that is your 50-day simple moving average, and the blue is your 200 simple moving average. And for those of you not familiar, quite simply, these are smoothed out lines of the price action over that time period. So this green is taking into account the last 10 days of price activity. So we can see this is that pickup that I talked about in June. And what I want to key in on here is the fact that the 10, the shorter term simple moving average, has crossed up through the 50. That is called a golden cross. That's actually bullish when that shorter term simple moving average crosses over the longer term. And now we have a 50-day simple moving average at the very least that is trending sideways. We certainly still have work to do before this staples sector turns positive. Ideally, we will want this 50-day to emerge into an uptrend and the sector as well as the simple moving average to cross above the 200-day. That does not mean that there are not plays, if you will, that can be made in the interim, but just know that there is potential resistance nearby with this 200-day simple moving average. So here is an example. This is Clorox, of course, from that consumer staples space, and it is typical of the move that we have seen. Now, last week I pointed out Kellogg, another staid company that experienced a turnaround, and that stock was up 4% last week. Clorox was up actually 5% last week. But what I did want to point out to you with this daily price chart of Clorox is that phenom where that shorter term simple moving average, in this case, this is the 10-day, is red, has crossed up. Now, I mistakenly have the 40. This should be the 50. But there was also a crossover of that 10-day above the 50-day, which would then draw that into an uptrend. And so now we have a stock that is freer to advance, and the odds are more favorable given that your simple moving averages are now in an uptrend. In this case, I've overlaid the RSI and the MACD, and these are also both in positive territory. The RSI is above that net neutral 50 and trending upward, as is the MACD above your net neutral 0 and also trending upwards. So while this is not the type of stock that I normally traffic in, I'm more drawn toward faster growth, but this is an example of a near-term play for those of you that have an eye for more conservative stocks. Now, what I also wanted to point out to you is, we reviewed this last week, but it does bear repeating, is taking a look at the candle glance view of various industry groups. And this is available to you on StockCharts primary interface page. You can simply go to Candle Glance, and it is populated already with significant indices and indexes, but I like to add my own in there. So what we have is 12 different sectors ranging from semiconductors to the S&P 500 and the Nasdaq as well. This is taking a look at performance over the last 2 months. And what you can do from here is go ahead and add an indicator. What I've done is added that RSI. This is the relative strength indicator, a momentum indicator. And from here, we can then sort that in descending order so we can get a very quick snapshot of where the strength is in the broader markets. So here we can see quite clearly the utility index. We talked about these higher yielding stocks coming into favor, followed by consumer staples, and then energy. Last week, of course, was a huge week for energy, with oil stocks rallying over 8% on fears of diminished supply. And energy stocks, of course, are getting hit today, but it is worth noting that this particular group is very, very volatile. It is tuned into the price of oil. There are stocks, however, that have emerged as leaders in this space, but just know that it will tend to be quite volatile. But what I've done here is added in an ETF, and this is SKYY is the ticker symbol. And what it is the computer software ETF. And this ETF is focused on softwares that are with cloud computing. So within the software space, I talked about prior to June, and this is even throughout the corrective period of the broader markets, these software, particularly cloud-based stocks, were super, super strong. And you can see this as it shows you the advance from May into mid-June. Now, more recently, they have gotten hit. Certainly last week with technology, a lot of these stocks were down, in fact, 5% and more. But the good news that I did want to point out here is that the software space within cloud computing did find support at its 50-day simple moving average. So a lot of these software stocks are finding support. So from my work, I have an eye toward a resurgence of these stocks over the near future. And then consumer cyclicals, we talked about that being a very healthy area of the markets. And what I wanted to point out with as it relates to consumer related stocks, both the cyclicals and the staples, is the fact that these stocks are going to be more immune from potential trade war fears. And there are a lot of experts that feel that these trade war problems are going to be here for quite some time. And with that, we've certainly seen a pickup in volatility. So with an eye toward concentrating and focusing on areas of the market that would be a little more buffered and perhaps immune, I would tell you that particularly the cyclical space, there are a number of stocks that are US based and US consumer focused, so they are better positioned to withstand any trade war fear volatility. So what we can do here, I did want to also emphasize the rotation that we saw last month in the month of June. And one of the top performing, in fact, this is the top performing ETF for the month of June, is IBUY. And this is the online retail ETF. And many of you may think that that is primarily or perhaps only because of Amazon. But what I did want to point out to you is the top weighted stocks within that IBUY ETF. And we can just take a quick look at some of these stocks to give you a sense that there is real strength outside of Amazon. This is Carvana. It's a small online retailer. Wayfair is another stock. Now, this one is unique in the sense that these are all daily price charts. We are looking at Wayfair, ticker symbol W. This is the second largest holding in IBUY, and you can see the clear-cut strength with this stock finding support at its upward trending 10-day simple moving average. And the stock, despite having had a large advance, it does appear to be building a base and setting up for potentially another leg up. And this stock is in the top 5 as well. And this is Etsy, ETSY. For those of you not familiar, this particular company is a platform for individuals to sell their crafts, if you will, online. Very, very popular organization. And what I wanted to point out to you with this stock is the fact that this is very typical of stocks prior to their advance. What we are looking at here is the price gaps up in the beginning of March on a very, very strong earnings report. And oftentimes when stocks gap up in that manner, a lot of people think that they may have missed the move, but the stock oftentimes, and this is during a very difficult period in broader markets, the stock did go on to advance further. And what you want to key in on is, in this case, the stock finding relative support at its 10-day simple moving average. These faster stocks will obey a shorter term simple moving average, but also these stochastics stayed above this 50, which is positive. And we did have another gap up here. Now, this is mid-June. It was in response to news that the company had raised its fees for those individuals that used their platform. So it was a significant expected boost to their income and revenue. So the stock gapped up. But again, the stock is retaining this significant move. It was up over 40%, but it is still holding in quite well. And that is really saying a lot for particularly this stock and for the potential move going forward. And Etsy also is on track for an 88% growth rate for this year. So that is what is going to help sustain this stock and keep it in this area. What we are looking for is the stock to continue to back and fill and, if you will, digest this significant gap up. A lot of times you can take a look at the historical move in these stocks for a guidepost for the potential move going forward. This company is going to be due to be reporting earnings again soon. And of course, that is, if they do come in ahead of earnings, could indeed be a significant driver. So let's go ahead back and take a look at some other areas of strength that are currently being exhibited in the broader markets, with an eye toward those areas continuing to be strong for sound reasons. The other, I talked about them, this iBuy and the online retail being potentially buffered from trade war. The retail space has just completed a very, very strong earnings season. And a lot of these retailers sat out last year. So there is an expectation from our work that these retailers will continue to hold up well and outpace the broader markets. Now let's take a look at another area that has been quite strong. For those of you that follow the markets super closely, you may have noticed that healthcare overall has really been just a market performer. It has not overall been doing really well. However, there have been in-depth pockets of strength, and this is one of them. We're looking at IHI, and this is the medical device ETF. This is a weekly price chart. So while you can see that the space has been strong, there is still continued strength. This red line is this 50-day simple moving average, and the in line with the broader markets, this grouping has pulled back just a bit. But the reason I'm pointing this out is for those of you that may be feeling a bit more defensive. We are going into the summer doldrums where the broader markets do tend to have a bit of malaise. They are not quite as active. This would be an ideal area to focus on, because not only are there a lot of highly innovative companies that are developing new products for an aging population, but also this space could be viewed as defensive within healthcare. There is a need for these products, whether it is there are a number of areas, diabetics, healthcare, and so forth, that are exhibiting quite a bit of strength. We can take a look at some of the stronger names in the medical device space that you can keep an eye on. This is IRMD, and it's IRMD, and this is, in fact, diabetic related company. But what I did want to point out to you here is on this daily price chart, you can see that the stock had a gap up here in earnings, and it did advance, but it needed a period to base and in essence, digest this gap up. But more recently, the stock has broken out of this flat base, and it's very clearly in an uptrend. So this is one candidate that I would urge you to keep an eye on, be a buyer on a pullback. Now, Haemonix, HAE, is another stock that is in an uptrend. It currently is pulling back to its very upward trending 50-day simple moving average, making it a potential candidate. From my work, I would like to see the stock break back above the above the 10-day simple moving average. And if that occurred on volume, HAE could be bought. And one last one is Align, ALGN. Now, this one is not quite as defensive because it is a teeth straightening. It is more cosmetic, but you can see the stock has had a significant move. It is pulling back. This is another one that could potentially be building a base. If we get the right side of a saucer and it breaks above the 10-day, that would be very, very interesting. Now, I did want to take time to review what to be on the lookout for as we are ending today's show for stocks that are potentially breaking down. And this is SPLK, Splunk. We're looking at a daily price chart. And let's take a look at some of the signals that would alert you to the fact that this stock could, in fact, be poised for more downside. First, we do want to, of course, pay attention to history. And we can see that this stock, this, of course, is the corrective phase. A lot of stocks have this look. But even more recently, we can see that this stock is a bit volatile. So when the stock initially broke this 10-day simple moving average, it was not as alarming because it had a history of being able to recover. However, when the stock broke its 50-day simple moving average, take a look at the volume on that break. And when you can marry that with an RSI that in fact turned negative, as well as your MACD, these are two momentum indicators. Your black line with the MACD, if it crosses below the red, that can be negative. But as the breakdown occurred, it went below this net zero. So we have three signals that are occurring simultaneously that is telling us that this stock very well could head lower. And then as we move forward, we have a death cross where the shorter term crosses below the longer term, creating a heavier pattern. So I did want to make sure that I showed you some of the signals to keep an eye out for within your individual portfolios so that you can, again, keep your profits and minimize your losses. And one last area as we close here is during corrective periods, or in fact during pullbacks, as we experienced last week, you do want to keep an eye toward those stocks that are bucking the downtrend. So software stocks last week, I talked about many of the subgroupings down 5%, individual stocks down 5-10%, some of the faster movers. But Salesforce CRM, in fact, did outpace the broader markets. The S&P was down 1.3%. We can see that this is as of the close last Friday. We're looking at a weekly price chart. So this stock actually rallied 1%, while this software enterprise grouping was down 3.5% for the week. So there's an anticipation that when the market pressures lift, those stocks that can outpace the markets and withstand the downtrend pressure are going to go on to be your leaders. That is historical precedent. And I am running out of time, so I will leave it with that. I was going to review a couple of the FANG stocks that look attractive now, but we can save that for next week because, as we talked about the Nasdaq being very much still in an uptrend, those FANG stocks are a large component of that space. Thank you.